Hello students, we are going to continue with our chapter 8. This is the third lecture and I have covered the concept and definition of capital structure, characteristics and what are the types of capital structure, right? See, for any company or for any corporate, there are mainly two questions will be there about to raising the finance and what are the things or what are the sources that are available, right? So first, to estimate the need of capital, that is the problem of capitalization, that how much capital that is needed into the fixed capital and into the working capital, right? And second, to determine the sources of capital, that which are the sources that are available, that we have already learned in the 11th standard, right? Like to raise the capital from equity share, preference share, or from the borrowed funds like debentures, bonds, public deposits, or taking loans from the financial institutions or from the banks. Okay, right? So here what company is going to do? Company is going to decide the particular sources of the capital that is cheaper, the cost of capital that is less, right? The flotation cost of the particular finance or raising the finance is less, right? What is the proportion? That means what is the ratio of the owner's fund and what is the ratio of the debt, that is equity or debt, whatever the things will be there, right? So here the finance manager, he is going to decide the policy, the strategy, right? That how to acquire the fund, how to utilize the fund, and what are the sources of the acquisition. Okay, right? In simple words, what we can say, that capital structure is the what is the proportion and magnitude of different securities that is issued and sources utilized by a company to raise its finance, right? Various securities that we know, equities are preference or debenture, right? Or taking loans from the banks, taking loans from the financial institutions, right? Or demanding money from the public as the public deposits or the bonds, right? So here the capital structure, or ultimately the capital structure is going to decide the success of the business, right? That if the proportion of debt is increasing, then yes, company needs to think about the or forming or changing the particular capital structure, right? Because see, when a company is taking a debt from the or taking a loan from the whatever the things, right? If their company is more reliable or more rely on the borrowed funds, then the payment, that is the default payment, that is going to increase, right? Whether the company is incurring profit or loss, company has to pay the particular amount at a fixed period of time. Okay, right? So here the optimum capital structure, it includes what? It includes the equal combination, right? Or equal proportion of owner's fund and the, getting my point, right? So characteristics, first, simplicity. Capital structure must be simple so that it can be easily understood by anyone, any person, that whatever the person who is working in any level of management, right? It is decided by the top level, that is by the finance manager, but still it need to be simple, that less number of securities that need to be there, not like that case, we are what we are raising the fund from the equity capital, no, then go for debenture, no, then go for public deposit, then go for what the, right? So a particular thing will be simple, right? Easy to understand, easy to implement. Second, profitability, right? The flotation cost that need to be what? That need to be lesser than the rate of return, right? Because whatever the fund that you are acquiring as a debt, right, you need to what? You need to pay some sort of interest, some sort of payment to, or to return the particular money to the creditor, right? So that rate of return must be higher than the rate of interest, then and then only it will be a profitable capital structure. Okay. Third, adequate finance. Finance must be adequate for each and every activity that will be going on or that will be taken into the consideration, or whether the whatever the activity that will be implemented must be having the adequate finance, whether it is a production, whether it is a marketing, whether it is a sales, whether it is a accounts, or whatever the things will be there, right? Then flexibility. See, this is the, you know, that what we can say, that is a necessary thing, that flexibility, it is necessary, right? Because yeah, if the company or the manager, they are rigid, right, to not to change the capital structure, not to acquire the other sources of the finance, then the company is going to run for a longer period of time. They are not going to survive into the market, right? So flexibility is necessary. Then economy. It must be, you know, that it must be a particular thing, like some economical things will be there, right? When you compare the particular rate, the cost, that expenditure that you are incurring of raising the finance, right, it must be lower than the return, it must be lower than the particular profit, or it must be lower than the particular expected returns, right? Okay, then balancing. Balancing, that means, as I said, there will be equal balance or equilibrium between the owner's fund and the borrowed fund. Owner's fund, that includes equity capital, preference capital, right, or the retained earnings that we have already learned in the 11th standard, right? So it must be a balanced thing. Why? Because in owner's fund you don't need to pay any kind of rate of interest, or you need, no, there is no default payment will be there, right? But when borrowed funds are there, we need to what? We need to give that particular default payment to the creditors. Okay, right? Then liquidity. Capital structure must be like that, which provides liquidity to the company. That means cash on hand, right? Okay, yeah, you are investing into the fixed capital, you are investing into the fixed assets, but same amount or same proportion of amount must be there as a working capital. Higher the larger the size of the business, that is also going to increase the particular requirement of the working capital. Okay, right? Then attractiveness must be attractive, so that investors, they are what, they are attracted to invest in the business. See, it can be a small investor, it can be an institutional investor, or whether it is a foreign institutional investors, right? It must attract it. Institutional investors like bank, insurance company, they are the institutional investors. Small investors, that means like us, the common person, the common people, right? And foreign institutional investors, foreign institutional investor, that means what? Okay, that foreign companies or the foreigners, they are, they are investing into the share market, right? Then solvency. Credit worthiness must be there, right? Because solvency is the thing, right? That when the structure is simple, structure is profitable, obviously that company is going to be solvent, right? That meeting the requirement of the default payment at the particular point of time, it is going to what? It is going to be called as a solvent capital structure. Or company's credit worthiness, that is also going to increase. Okay, right? Then next, types of capital structure. See, many times that 1 mark of a question or MCQ that has been asked by how many types of capital structure are there. So mainly 4, right? First, capital structure of only equity share. Only equity share, they are the true, that they are the true owners of the company. Second, preference shares with equity shares. That means the preference share that we have already learned in the 11th standard, that it is redeemable before 20 years and it is redeemable after 20 years. That those who are, that want to invest into the safe money, right, they want to play safe, then they are going to involve this, that is preference share, and with equity share. Then capital structure of debentures with equity share, not a preference share but debentures, that is the borrowed fund with the equity share. And last one, that is preference share and debentures with equity share. That means all the things that has been utilized, right? In option D, yeah, okay, fine, the raise of a finance, that or raise of a fund, that can be easily achieved, right? But the meeting of the file, that default payment, that is going to increase, right? So mainly 4 types of capital structure that are there. Okay, that's it for today. Thank you. Just go through it. If you have any doubt, do let me know.